Good morning. Thanks for joining us for this webinar presented by the Nonprofit Finance Fund in conjunction with Cuyahoga Arts and Culture. If you're having trouble seeing the screen, please let us know by using the chat function on your GoToMeeting toolbox. You can select that you'd like to send a message to the presenters, and that message will come to us here. We'll do our best to respond to any technical difficulties as you send us your messages. So now to get started, good afternoon, everyone, and thanks for joining us again. This is a 90-minute webinar scheduled from 12 to 1:30 p.m. Eastern Time. We do have quite a number of participants on the line today, and so all participants are muted. We do, however, want to try to get your participation, and so to do that, we would ask that you use that chat function to send us any comments or any questions that you have. We'll try to answer any clarifying questions as they come in. However, we may also try to reserve a lot of time at the end to answer some of the questions that we think would allow more discussion time. My name is Nicole Simino. I'm the Director of the Pacific Northwest and Southwest Program at the Nonprofit Finance Fund. And joining me today is my associate, Jessica Prue, who also works with me in NFF's Western region. Both of us provide consulting services to foundations as well as to nonprofit organizations around the country. We work with quite a number of arts and culture organizations as well as additional organizations across the entire sector. I'll tell you a little bit more about the Nonprofit Finance Fund momentarily. I do want to start by mentioning our relationship with Cuyahoga Arts and Culture, which allowed us to bring this webinar to you today. Our relationship with Cuyahoga Arts and Culture dates back a year to two at this point, and we're building off of the work that we did with CAC on their general operating support funding formula. If you'd like more detail on that work, you can see a webinar that we prepared. It's listed on CAC's website under Tools for Grantees. We encourage you all to take a look at that if you're applying for the general operating support grant. We're continuing to work with CAC because of their commitment to building the financial health of the organizations in which they invest. Having a strong arts and culture ecosystem in the Cuyahoga area is also about having a system comprised of strong organizations. That's really the first step in building a strong ecosystem. CAC very much understands that for organizations to serve and strengthen their community, they must be financially strong themselves. While your passion for arts and culture is what brings you to this work, if you can't keep your operations afloat, you can't achieve your mission. So there's a lot of synergy between NFF's work and CAC's work, and we're really honored to be able to continue to work with this webinar today. I want to tell you just a bit more about the Nonprofit Finance Fund as we get started for those of you who may not be as familiar with us. The Nonprofit Finance Fund, NFF, is a 30-year-old organization headquartered in New York City but with regional offices around the country. While we started off as a lender serving nonprofit organizations, our organization has grown to include financial consulting services as well as advocacy work in the nonprofit sector. We work with both lenders as well as with nonprofits, trying to really move the sector forward and address some of those systemic, structural, and behavioral issues that hold our sector back from its full potential. We'll talk through some of those structural and behavioral limitations in a moment. We are about a 13 million. Oops, sorry, I haven't. Go. I'm going to try and fix that one moment. Okay, let me see if that helps. Okay, sorry about that echo. So let's keep going. So the Nonprofit Finance Fund, offices around the country, we do both financial consulting, advocacy, as well as consulting work, working with organizations like yourselves, not about helping them improve their accounting systems necessarily, but really about helping them make better decisions off of the data they have and be able to confidently communicate their financial position to both funders and other stakeholders. Why does the Nonprofit Finance Fund believe that finance is so important? So clearly we're a little biased here, but we want to make it known that we're not focusing on finance purely for finance's sake. Very much in line with what CAC believes, we're focusing on finance because it's crucial to your ability to delivering on your mission. I'll tell a quick anecdote to that effect. We had a client in a major metropolitan area. This organization had an executive director that was a very dynamic person who had won awards, nationally recognized, very magnetic personality. Their board consisted of all the heavy hitters in that community. You know, everyone who is anyone is on this board. Their programs had won series and series of national awards for program excellence and innovation, nationally recognized programs. When it came to fundraising, they definitely knew how to raise money. In fact, they decided to expand their operations with a new facility and set out, they set out to do a capital campaign to raise $8 million for a facility. They actually raised $12 million, which was $8 million for the facility and $4 million to help support the organization's growth and operations in the new facility. They raised that money very quickly, had no problems doing so. A year later, they shut their doors and laid off 340 people. And how is it possible that an organization with a nationally recognized ED, a board of all the heavy hitters, award-winning programs, and the ability to bring in $12 million in a year is going out of business? And the reason is because no one was really understanding the strategic financial health of that organization and how it related to their future plans. No one really understood whether $4 million was enough for the organization to grow into its new space. No one really understood whether the organization had the balance sheet or the risk tolerance in the first place to be undertaking such a large facility project and organizational growth and expansion. And so if that piece is not at the foundation of your organization's decision-making, it really puts all of your other good work and fundraising and program and leadership, all of that becomes at risk when there isn't a foundational level of strategic financial management at the enterprise level. So this is really why we want to help the sector improve its strategic financial management. Ultimately, it's about mission. Quickly want to say a few words about what we hope that you'll get out of this session. We're going, as I promised, to talk through some of the limitations to the nonprofit sector. We say that we're operating in a flawed system, and this is a really helpful sort of shared understanding for everyone on the phone. Then what we are going to do is learn the basics of assessing the financial condition of nonprofit organizations. That should be 100% applicable to your organization, whatever your organization is. We're really, in a way, taking you behind the scenes to tell you how NFF analyzes nonprofit organizations. And this is the analysis on which we have been basing lending decisions for 30 years and has been the basis of our foundation, of our consulting work for 10 years. We're also at the end going to introduce a tool in the Cultural Data Project created in partnership with NFF that can help your organization build an understanding of your historical financial health really at the click of a button because you're already in the Cultural Data Project. Other than that, I think my goal today is that we really want to help you all feel, one, empowered to understand and assess your own financial health with confidence. But two, we also want you to feel empowered and capable of communicating your financial health transparently and without apology. All right, we're going to get started on our main content for the day. The first thing is going through the challenges of nonprofit finance, some best practices that inhibit nonprofit health. To do that, we're going to take a little trip to the for-profit world first. Let's take the example of our friends at Starbucks. The example is that you are going to walk into Starbucks, you are going to get a 12-ounce latte, which at some point seems to have cost $3, although it seems like that's a little out of date today. So if you go into Starbucks and purchase that 12-ounce latte for $3, the amount of that money that is truly paying for the direct cost, meaning the labor, the utilities, the hard goods of the cup, the lid, the sleeve, the stirrer, and your ingredients like your espresso and your milk, that is only 26% of that $3, or about 77 cents of that $3. the remaining 74%, a little over $2, is for overhead and profit. So what would happen if we went into Starbucks and said, well, we have personal, feelings about overhead percentages, and so we'll pay you 77 cents for the direct cost of this latte, and we'll pay you 10% overhead. We'll give you 90 cents. Would Starbucks give you your coffee? No, they wouldn't, because they reserve the right to say, this is what we are charging for our product, which includes the fact that overhead and profit are necessary and regular to running our business now and preparing for the business that we want to run in the future. And we all, as a whole market, accept the fact that Starbucks has that right. And we willingly will pay 74% overhead and profit for a company like Starbucks. Well, this is a little different from the nonprofit world. In fact, in the nonprofit world, we have a number of limitations that are both structural and behavioral. So looking at the structural issues first, nonprofits exist inherently for a market failure. In other words, there is not an obvious way to make a commercial return on the services that we provide. If they were, a for-profit company would be doing those services. Additionally, quality considerations make economies of scale elusive. This is very much an issue in the arts, very much an issue in things like education. For example, in the arts, can you ask every person, can you ask your violinist to start playing 2 violins so that you can cut down on your expenses per concert? No, you can't, right? There's labor economics and quality considerations that make economies of scale elusive. Related to this market deficiency, which is why nonprofits exist, the next 2 bullet points really stem from this. So the client does not pay or does not pay fully for the product. The example here we're giving is a night in a homeless shelter, but in the arts world, when a customer buys a ticket, is that ticket really paying for the full cost of what it takes to put on that production and support the organization that does so? No, it's not, and we very much accept that. But what that means is that this adds a layer of complication for us. We're no longer talking about very simple rules of supply and demand. It's a more complicated equation for nonprofits. And we also have different sets of clients, right? Is your client the person that receives the services, or is your client the person that pays for the services? It's really both, but that means we have different types of clients that we have to serve at the same time. Related to this aspect is this reliance on third parties. When the clients don't pay the full cost of what they're receiving, we have to seek third parties who will subsidize that cost. We talk about this as being a required dependency on fundraising. A lot of funders will say, well, how long until they don't need my money anymore? And that type of question really hints that there's not a full understanding of the market system in the nonprofit world. There's a required dependency on subsidy. But what this means, on top of the fact that these aren't any longer simple rules of supply and demand, it also means that your organization is operating 2 businesses. Your core business, which is related to how you carry out your mission, and then your subsidy business, which is how you subsidize the cost of doing your core business. Those 2 things are separate businesses requiring separate sets of staff, systems, strategies, and capital. The next 2 bullet points really relate to some of the behavioral limitations in the sector. And I like to think of these as good intentions gone bad. So first, what we have is that the donors and funders want their contribution to go directly to the people served. There's clearly good intentions behind that wish. But what often happens is that we end up restricting dollars, or we end up putting far too much pressure on things like the overhead ratio that actually limit the organization's ability to do what it does best, meaning deliver on its mission and serve the people that it's serving. Related to this, really sort of stemming from this, is that overhead and profits are seen as unnecessary and unrelated to achieving the mission in the nonprofit world. This is a fallacy. It's absolutely not correct. Overhead and profits are a necessary part of doing business, but there is a belief, there is this misnomer, misconception in the nonprofit world that that's not true, and behavior has tended to follow that misconception. I'll look a little bit more deeply at a couple of these issues. I talked just now about how overhead and profits are a necessary part of doing business. Nonprofits need profits. That's one of our main takeaways from today's workshop. But how large should a profit be? Should your organization be charging a 74% margin for overhead and profit? The answer really is that there's no clear benchmark that says this is a good profit point, right? 5% is a good profit, nothing like that. There is a very quantifiable way for your organization to understand what the right amount of profit is for your organization. To do that, you want to understand what is the full cost of running your business rather than just your operating expenses. Full cost includes a number of things that are piled on top of your operating expenses. So this pie chart that we have here shows an organization's full cost. They're not necessarily equally distributed, but we're showing the different components. So first, as you see in the green, there's operating expenses. We all know what those are. That's just your day in and day out expenses to run your business. But everything else on this wheel, the money to pay for debt principal, the money to build your working capital or other types of reserves, and the money to pay for the care and feeding of your fixed assets or invest in new fixed assets, all of those things are not part of operating expenses, and yet you need revenue in excess of expenses to be able to pay for those items. So we say budget not for your operating expenses, budget for your full cost of doing business. The difference between your operating expenses and the full cost is that surplus or profit that your organization needs to bring in. But the really important cultural and mental shift is that surplus doesn't mean extra. Surplus on an operating basis means that it enables you to pay for your balance sheet needs and invest in your organization's ability to operate long into the future. I want to say another word or two about subsidy businesses. We all operate at least two businesses. We have our core business, and then we have our subsidy businesses. There's a number of ways that nonprofits seek to close that gap and cover the difference between what it costs and what they can charge. Fundraising is definitely what we think of as the most common business, but we actually believe that there is a greater source of value in the nonprofit sector that helps to close the gap, even beyond all of the fundraising, and that is sweat equity. Sweat equity is really the first source of subsidy that we all use. Underpaying, overworking your employees, and providing low benefits, or relying on the use of volunteers. This is probably the greatest source of subsidy that we use. Second to that is fundraising, which needs no explanation. Alongside fundraising is trying to garner in-kind contributions to limit the amount of cash we have to outlay to cover expenses. Additionally, there are things like earned income ventures, investment income, and real estate ventures that help to also bring in dollars. Investment income would be having something like an endowment or a board-designated endowment where you're not intending to use that corpus, but you do intend for that money to earn interest and dividends, which can then flow through to your income statement to be used to cover your core work. Or rental income being you buy a building that is larger than what you need and you rent out the ground floor to businesses in the community. You're entering the landlord business if you do that. You're not in existence to be a landlord. You're doing that because you believe that that will throw off cash flow and revenue to help support your core business. Earned income ventures, similarly, we often talk about social enterprises. It's really the same thing. It's doing things that hopefully are related to mission, hopefully are leveraging some of your core competencies, but really that you're not existing just to do those ventures. You're doing them because they're going to throw off a profit to support your work. And you wouldn't be doing them if they were producing a deficit and requiring a subsidy. Next, we mentioned restricted funding. Restricted funding comes really from a good place, which is that we want to make sure our money is going to the, to do the things we want it to do and to the people we want it to serve. In reality, though, this is a very difficult management quandary in the nonprofit sector. Thinking back to our Starbucks example, if Starbucks was restricted in how it could spend its money, and then had to report to every single buyer how it spent that money and prove to them that it was spent only on the things that it was meant to be spent on, how long would Starbucks be able to be in business? And what other types of infrastructure would it need in order to have to manage through a difficult system like that? But in the nonprofit world, this is normal. We all have gotten restricted grants, I'm sure. This is very much accepted. And this really makes it difficult to get what we need to pay for our work, because we're often then put in that position of our restricted grant is only going to pay for something, the direct cost of a program, and then we'll attach on a very small amount for overhead, if anything at all, which ultimately means the organization is not covering its expenses. Those are some of the structural and behavioral issues that create what we call a flawed system in the nonprofit sector. It's helpful to have that shared understanding to begin with, even before we look at a single financial statement, so that we're all on the same page about the conditions that we have to manage within day in and day out. But with that, we're now going to move on to the next piece of our agenda, which is assessing financial health of a nonprofit organization. And we very much want you to be thinking about how this applies to your own organization. When we think about a financial assessment of an organization, we also call it uncovering the financial story of an organization. There are several pieces to it. The first is understanding the organization's operating performance. The next thing is determining the strength of the balance sheet, followed by understanding the organization's ability to handle risk and pursue opportunity. Altogether, we feel that this is what creates a comprehensive financial analysis. As I mentioned, this is really NFF's brand of financial analysis on which our 30-year business nationally has been built from. So this is a place where we feel like we very much know what we're talking about. We've invested our own dollars on the street in nonprofits based on the ability of this financial analysis to help uncover the real strengths, risks, and challenges of a nonprofit organization. I'm going to take you through the first piece of this work, which is understanding operating performance. Let's talk first about the sources of financial data that your organization may use. Typically, the most common financial statements that organizations use are these. The first being audited financial statements, which is going to consist primarily of your balance sheet and your statement of activities. You may have, in place of an audit, a compilation or a review. These are statements similar to audits in that they are compiled by a CPA outside of your organization, and they will follow similar formatting guidelines. They differ with the level of severity of verification that is required from the CPA to do. So with an audit, the CPA is saying, we're basing our reputation on the fact that we can say these statements are accurate. We've done enough testing to say we can verify these are accurate. A review has a dialed back level of verification. A compilation doesn't have any testing. This is where a CPA compiles your financials so that they look the way a review or an audit is going to look. But they're not doing any testing, and so they're not going to be able to make any sort of statement that says we can guarantee that these are truthful. Compilations are still good because at least it puts your information in a standard format. But of course, the more rigorous testing that can be done, the more reliable those statements are, which is why audited statements are really very highly recommended. We also certainly hope that your organization prepares a budget every year, which would be a plan of how it expects to bring in revenue and how it expects to spend that revenue to carry out its mission and its subsidy businesses. We hope that also organizations are preparing monthly reports from their financial systems that say how they're performing in the year to date against their budget. And there are variations on this, like monthly budgets and reforecasting that you can do through the year. But the big piece here is you want to have something between your budget and your audit, right? You want to have something that says how you're managing to those results that you planned for. Additionally, probably the least common but also very common is program-specific budgets, that your organization has an understanding of where it's making and losing money and what are the actual financial dynamics of the different programs that you run. We're going to focus today on audited financial statements, partly because we know that this has a standard presentation format and also because this is verified, reliable data. But this type of analysis can be done with any sort of historical financials. It doesn't have to be audit. It could be the internals that you run for your organization at the end of each fiscal year. Certainly, doing a comprehensive financial analysis is also going to include looking at the current year and how you're managing in this current year. But that really comes on top of understanding the historical financial trends and current position, which is what we're going to start with right now. Briefly, these are the financial statements that are included in a nonprofit audit. The statement of financial position, which is our term for a balance sheet. We also have a statement of activities, which you may also know as an income statement or a profit and loss statement. The statement of activities, the income statement, connects to the statement of financial position, which is really important. So the statement of activities shows us the money we're bringing in and the money we spend. At the bottom is our bottom line, whether we made or lost money for the year, a surplus or a deficit. That surplus or deficit will flow into the balance sheet, and our net worth as an organization will grow by the amount of our surplus or contract by the amount of our deficit. You'll see a lot more clearly how that connection is made, but this is really important, that the operating activities that we do during the year, they either are going to increase or decrease the health of our balance sheet. The other two statements listed here are worth mentioning briefly. They also all connect together. First, on the left-hand side of the screen is a statement of cash flows. This is not cash flow projections. Cash flow projections is a budget for how your organization plans to bring in and spend cash during the year or during some future period. It's used to help you understand when you may be low on cash and may need to think about alternate ways of making sure that you can have cash on hand to cover the expenses you need to cover. A statement of cash flows is similar in a way, but the main difference is that a statement of cash flows is looking backwards. It's looking at the year that already finished, and it's saying, where did the organization's cash come from, and where did the organization spend cash? The bottom line tells us how we got to our balance of cash that we have on our balance sheet at the end of the fiscal year. The other statement on here on the right is our statement of functional expenses. We often think of our expenses as a program, admin, and fundraising expenses for good reason, because that's how expenses need to be listed on the statement of activities. This expense line here on the statement of activities will not give you detail about what's fixed, what's variable, what is really your organization's expense structure. You won't get that detail on your statement of activities, unfortunately. It's just program, admin, and fundraising in large buckets. So the statement of functional expenses breaks out those categories and said, well, let's talk about, fixed versus variable. What did they spend on people? What did they spend on contractors like artists? What did they spend on office expenses, travel, et cetera? And it really gives you a better sense of how the organization spends its money and what its expense structure is. But it's just a breakout of the expense total on the statement of activities. Moving now into the first piece, to understand operating performance, the statement that we're going to focus on is a statement of activities. This is where you look to understand operating performance. There's a wealth of information on your statement of activities. It tells us a lot about revenue dynamics, where your money comes from, is it diversified, is it consistent. It tells us a lot about our cost dynamics. Even just at the level of program admin fundraising, we can see changes in those larger buckets, and we can see our overall expense levels. How have they fluctuated in time? And most importantly, are they adjusted in line with changes in revenue that happen over time? This is where we also look to see profitability. Is the organization living beyond its means, or is the organization living within its means and spending an amount that it can afford each year? And this is really the key piece. What I'd also add here is that looking at trends is always more valuable than looking at a single year. The real goal would be to have several years of financials that you can layer next to each other. And seeing several years next to each other is really where you get a much richer view of these dynamics by seeing year-over-year changes. Now, this is in some ways a cheat sheet to help you look at your own financials and ask the right questions to make some observations. But I'll tell you up front, there's one key takeaway from this section. And that is, when you want to understand operating performance, you want to know if you're making an unrestricted operating surplus. So if you can only remember one thing from this section, it's operating performance means unrestricted operating surplus. We're going to now tell you where to find that and also illustrate why it's important. To do that, we first want to talk a little bit about revenue. We have this issue of restrictions in this sector, and relatedly, in order to understand operating performance, we first need to be crystal clear about the nature of revenue in our organization and how it flows through the organization. There isn't any general dollar. Every single dollar that comes into the organization is in one of three buckets. It's either unrestricted, it's temporarily restricted, or it's permanently restricted. Unrestricted revenue has two flavors. It can be earned or contributed. Earned revenue is like ticket sales, and it is by nature unrestricted. Someone cannot buy a ticket to an opera and say, I only want this money to go to pay the soprano. It's by nature unrestricted. They're paying for a good that they receive. Contributed revenue is also a type of unrestricted revenue at times. Unrestricted contributed revenue would be like the annual fund where people mail in checks. It's a general operating support gift from a foundation. Special event revenue if you don't claim that it's going to fund a specific project. Any type of any type of general operating or unrestricted donations that come into the organization. Then there's temporarily restricted revenue. The only people that can restrict revenue are donors. Board cannot restrict revenue. Staff, the executive director, the artistic director cannot restrict revenue. Only the donor can. And money can be restricted in two ways, by purpose or by timing. By purpose means that the donor specifies the way that the funds can be used and what the funds can be used to cover. So for example, I'll make your organization a grant, but this can't go towards your season of theater. It needs to go only to fund the education work that your theater is doing in schools. The money comes to your organization, it's cash or it's a receivable, but either way, you can only spend it for those certain activities. Money can also be restricted for timing. Timing would mean really a multi-year grant. So I'm going to give you a gift, but I'm specifying the time period within which you must spend that money. So typically it's like, say a $300,000 grant over 3 years. I can give you that money in a suitcase in cash, but you still can't use the second 2/3 of it until those fiscal years begin. Money can also be permanently restricted. what we're talking about here is a permanently restricted endowment, meaning the money given to the organization can actually never, ever, ever be spent. The purpose is that that money will generate its own income by being invested, and that investment income would flow through the organization in order to be used as unrestricted revenue. So let's talk now about how this revenue flows through the organization. And let's start by looking at how expenses fit into this. If you look at this visual for a moment, where do you see expenses? You'll notice that expenses are listed only in one spot, down on the bottom right, are operating and non-operating expenses. And you'll see that the only faucet that can release the dollars to cover those expenses is the unrestricted bucket. Only money in the unrestricted bucket can be used to cover expenses. It's really important, and we'll revisit that. So what does this mean? So what if you have temporarily restricted dollars? How do you ever get to spend them? Well, there's no expenses that are going to be covered by temporarily restricted dollars. There's a midpoint that has to happen. Your organization has to release money from your temporarily restricted bucket into the unrestricted bucket. And once that money is released, it then becomes unrestricted, and then it can be used to cover expenses. So when we talk about unrestricted dollars being the only dollars that can cover expenses, we are including in that any restricted dollars that are being released and unrestricted to cover those expenses. But the money that is still sitting in the temporarily restricted bucket and hasn't been released yet cannot cover expenses. Permanently restricted income, we talked briefly about that. That money is never going to be released from that bucket. However, investment income could flow from that permanently restricted bucket into the unrestricted bucket, and then it can be used to cover expenses. So let's translate this now to looking at an actual organization's statement of activities and thinking about operating performance. So when we talk about operating performance, we're really saying, again, did this organization live within its means? Did it bring in enough money to cover the things it needed to pay for? So this statement of activities is a pretty standard representation. You have an unrestricted column, a temporarily restricted and a permanently restricted column, and then a total column. This format is dictated by our generally accepted accounting principles. Our auditors are required to present our income statement in this type of breakout. If you have no permanently restricted activity, they might just eliminate that column, but this breakout has to be provided. So where do we look to see if this organization is living within its means? Well, a lot of times, if we don't really know better, we go to the bottom line, the change in net assets line, which is really the same as surplus or deficit. And then from there, we say, let's look at the total. And we see this organization, their total surplus or deficit is a negative $246,000. In accounting language, that's correct. There was a change in net assets in total of negative $246,000. That is not the same thing as whether or not this organization was able to bring in enough money to cover its expenses. If we think back to our bucket analogy, what can you use to cover expenses? Unrestricted revenue. So if we want to know if they covered their expenses, we need to look only at the unrestricted column, not the total column. So this organization brought in $1.7 million in revenue. These are dollars and thousands. And then $1.2 million in expenses, the result being a $445,000 surplus. Let me explain briefly how we get to different numbers in these different columns and why they, in the end, are, in accounting terms, correct. Let's look first at the temporarily restricted column. This says negative $691. So what that means is what? That they lost $691,000 from their temporarily restricted revenue? Well, what do we have here? It says $58,000 came in to the organization as restricted revenue. Then, in this net assets released from restriction line, there's a negative $749,000. So if we think back to our buckets, that means during the year, $58,000 flowed in to the bucket, and also during that year, they turned on the faucet and they released $749,000 into the unrestricted bucket. So, excuse me. And so if we look at the end of that year, the watermark on this temporarily restricted bucket is going to be $691,000 lower than when the year started, because they brought in a little bit, but they released a lot. So at the end of the year, the balance in that bucket is low. That's what this 691 is saying. It's saying the change in that bucket is negative 691. 58 came in, 749 went out. You'll notice in the unrestricted column on net assets released from restriction, the 749 is an equal but opposite number. And that should always be the case. You release money, it has to go directly into another of the buckets. So our first piece is really done. Unrestricted results, right? And all you know now that all you need to do is look at the unrestricted column and why you need to do that. But the whole piece is unrestricted operating results. In the nonprofit world, all revenue is treated the same, whether it's operating or non-operating. And you want to make sure that when you look at your performance, you're really understanding operating results. There's two main examples of non-operating results that can fuzzy things in operating performance. And I'm going to focus on those because that will account for 99% of the situations. So in this example, the organization has a $445,000 surplus, very, very large surplus off of $1.2 million in expenses. So does that seem normal for the organization? That's what we would call an amazement number. And in fact, what we learned by looking at this organization more closely is that $597,000, if you see here, was released from restriction, but it was released for non-operating reasons. So our net assets released from restriction line up top, it was $749, it's now $152. They released $152 for operations, programs and staff, etc. With only that revenue included, their revenue is not $1.7 million anymore, it's $1.1 million, $1.2 in expenses. And that means they had actually an unrestricted operating deficit rather than a very large surplus. The difference is because $597 was released for non-operating items that had no corresponding expenses. And as a result, your total bottom line when you add it together is $445,000. So what could make this happen, that there's a large release of non-operating revenue and no corresponding expenses? The biggest example is capital campaigns. So what this organization did is they invested in a facility. But when you buy a facility, it's not going to show up on your income statement. It's not just going to show up underneath, the paper clips and the travel line, that you bought a building. You're going to pay for that building, quote unquote, over the course of 30 years through your depreciation expense. Your depreciation expense being a statement that sort of says, okay, this is how much of that building we used this year, and we're going to pay for it this year. And you're spreading it out over 30 years. In the year that you make that purchase, it doesn't show up on your expenses, but the revenue does. So you have a lot of revenue with no expenses. That's going to make it look like you had a really big surplus. But in fact, this organization, although they had a very large, quote-unquote, surplus, on an unrestricted operating basis, did not even cover its expenses. So pulling out capital campaign revenue, that's the first example. The second biggest example is pulling out gains and losses on investments. Let's take me as an example. This year, I'll earn a salary and I'll spend it on my living expenses. And I might be spending money well within my means, sticking really closely to a budget, but at the end of the year, my retirement account did not do so well. And so the value of my retirement account is a lot lower than it was when it started. If you made an income statement for me as a person, and you just took what I made and what I spent responsibly, but then you showed that paper loss on my retirement account, that would make it look like I lost money. did I really lose money? It sort of depends on how you look at it. If you're my net worth might have contracted by that amount, in the stock market, but it doesn't mean that I was living beyond my means, right? Big difference. So those paper gains and losses on investments are the other big thing that we don't really want included in revenue. We want to pull it below the line. So, it's important, but we just want to look at it separately. There's other types of non-operating items, but those two things are going to be 99% of the situation. So as long as you look at those two, pull out capital campaign revenue and pull out realized and unrealized gains on investments, your battle is really done. And then you can understand the unrestricted operating surplus of the organization. So to show this graphically, this is the same organization presenting years from 2006 to 2011, their budget. Both sides are the same. Same organization, same set of data. They're audited financials. But on the left-hand side, we presented their unrestricted revenue just as it is on the audit. So just the unrestricted column, but it has non-operating dollars in it, capital campaign dollars. On the right-hand side, we pulled out the dollars that went to the facility. The green shows their revenue, and the purple shows their expenses. On the left, this organization has generated very significant surpluses in 4 out of the last 6 years. On the right, this is an organization that has had difficulty breaking even and has had deficits in 4 out of the last 6 years. The point being, as the manager of your organization, you're going to be making different decisions, we hope, based on which one of these data sets you're looking at. If you're looking at the data set on the left, or this interpretation of the data set, and you believe that this is the true health of your organization, that you're generating these large surpluses, you're going to make different decisions than if you're looking at the data interpreted this way, where you have a clear, transparent understanding of how much revenue you're bringing in to cover your expenses. We talked about the pie chart earlier of full cost of business. So just briefly here, I'm going to show you what that looks like graphically. The purple column is the organization's operating expenses in each of these years. And on top of that column are the other items that account for their full cost of business. Things like paying off debt principal, paying for the care and feeding of their facility, and setting aside savings for their reserves. When you do this, you see that not only has the organization been generating operating deficits, they certainly haven't been covering their full cost of business either. To wrap up this section, I want to say briefly that for operating surpluses, it's not that you need to have one every single year. What we say is healthy is that you're consistently covering your operating expenses and thinking through, what size surpluses are appropriate. Doesn't mean that there are years when it doesn't happen, or it doesn't mean that there aren't years where you strategically decide to spend down pieces of your savings and technically run a deficit. But consistently, sort of generally speaking, you want to be having annual surpluses. Moderately healthy, we would say, is that sometimes you have surpluses, or maybe you have surpluses, but they are very, very not proportionate to what your full costs are. So you're covering expenses always, but you have a lot of full costs on top of that you're not covering. If your organization is consistently running deficits, or the deficits are growing in size, that is really a red flag. So I'm going to now pass this to my colleague Jesse, who's going to take us through the balance sheet section, which is where we talk about understanding the health of the balance sheet and assessing risk tolerance and liquidity.
Great. Thank you, Nicole. And if anyone does have questions as we continue on through this, I would encourage you to use the chat function so that we can make sure that we address any questions that you do have. So like Nicole said, another critical piece of assessing true financial health of an organization is the balance sheet. And it is also the part of assessing financial health that I think can be most scary. And before I started at NFF, I was not a huge fan of the balance sheet, but now that I understand what it can do, and I've seen what it can tell an organization, I think it's really crucial, and I hope that today we can convey to you why it is so crucial in understanding your financial health. So when we talk about the balance sheet or the statement of financial position, what we're talking about is a picture in time, which is essentially, if you think back to when you were in elementary school, a yearbook picture. It shows at the end of 4th grade, at the end of 5th grade, at the end of 6th grade, where you were. It's just a quick snapshot in time. That's exactly what the statement of financial position is with the balance sheet. We're taking a snapshot of the assets, which is everything that you own, liabilities, which is everything that you owe, and then net assets, which is everything that you own free and clear after you subtract out everything you owe for assets. Now, that's probably a lot of financial jargon for you, but if you think in terms of personal finance, it's actually pretty intuitive. So if you think about buying a car, when I went to buy my car, I saved as much as I could, but I didn't have quite enough to purchase the entire car. So my car would show up in the assets. The portion I own, free and clear, that I paid for would show up in net assets. But the amount that I took out to help me buy that asset would show up in liabilities. So what we're looking at here is just a snapshot of where you are in each of those categories. So here are a few questions that are helpful to think about as you look at your balance sheet and question how strong you are as an organization. The first thing that shows up on all balance sheets is cash, and that probably gets a lot of attention from many of your organizations. We'll talk a little bit later about interpreting that with caution. So just looking at how much cash you have on hand may not tell your true story if some of that cash is because you have some debt, or if that cash is because some of it is restricted cash. So we'll get into later what a better measurement is, but cash is certainly important to keep in mind as well. The second line item on many of the balance sheets is receivables. And what we mean by that is essentially IOUs. How much money do people owe you for something? And a quick note for those of you that are using internal statements, one thing that you'll want to be sure is whenever you get a letter from a foundation or from a donor saying, I will donate in the future, you want to be sure that you're recording that in your receivables. So that's money that is owed to you, and when you submit your financial statements to an outside organization or to a funder, to anyone that would want to interpret your balance sheet, you want to be sure you're being all-inclusive in terms of how much people owe you. The other big piece in assets is fixed assets, like I was talking about with the car, maybe a car or a building. And if that is a big piece of your balance sheet, you'll want to be sure that you are saving the total costs of that building, like Nicole talked about before, making sure that you're funding depreciation with your operating surpluses. The other two sections of the balance sheet that I talked about before, liabilities is everything that you owe. So a line of credit will show up on there as well. The line of credit is similar to a credit card in personal finance, so it's how much money you need to support your cash flow. And a big distinction here is to make sure that you're using a line of credit to support cash flow needs, not cash needs. So for example, in December, when I need to buy presents for the holidays, it is a matter of cash flow. I don't have the cash, but I'll have it in January when my paycheck comes. If I'm billing up my credit card and spending more on presents than I could ever pay back, then that's an issue. So when you look at the line of credit for your organization, really think through whether it's cash flow or cash. That's the real reason why you're pursuing that line of credit. The last section is net assets, which is what you own free and clear. And we'll get into this in a little bit, but that's where we really look to see what the adaptive capacity of an organization is. So to help you think through whether you have the resources that you need to adapt to any changes that may happen in the future. So with that, let's take a look at a sample balance sheet for the same organization that we looked at the income statement for. By putting 2 years side to side, we can really look at the trends of what happened at the organization and see the true story. So if you look here, just take a quick minute on your own to look at what changed between the assets in 2007 and the assets in 2008. So you'll see that property and equipment is a big piece. That increased from 256,000 to about 760,000. So just from looking at the balance sheet without talking to anyone, we know that that organization acquired a pretty significant amount of property in that year. We also know by looking at the receivables, which is how much the organization is owed, they were owed about 612,000 in 2007, and that went down to only 55,000 in 2008. So the story that this balance sheet is telling is that they had some IOUs that they collected, and now they have fewer IOUs. And likely, the story that we get when we look at this is that it's likely because of the property. They maybe did a capital campaign, had some temporarily restricted receivables that they then used to purchase the property. And so the big takeaway here is that when you look at your balance sheet side to side from year to year, making sure that the story that you're telling as the narrative of your organization really matches to the story that your balance sheet is telling about the organization. And this is looking at the same organization in graphical form. We see cash as a decent part of their operations in 2007. Receivables is a really large part. Property is small and other assets are small. If you look then when you shift to 2008, property really jumped up. And the key takeaway here is that you need to know what the driving asset of your balance sheet is. So in 2007, receivables were a really big part of everything that the organization owned. So it was really important to make sure those receivables came in and that they were managing their receivables. As they move into 2008, property and in the future property will be a big part of their balance sheet, and they need to manage to that new reality. So the other big takeaway that you can get from the balance sheet, going back to the bucket analogy that Nicole spoke about earlier, is we can look to see how much adaptive capacity an organization has on their balance sheet. And what we mean by that is how much of that water in the unrestricted bucket do we have to pay for those operating and non-operating expenses. Like Nicole said before, only unrestricted water can pay for the expenses. And so the caveat being that when we look at what an organization owns free and clear that is unrestricted, there are a few things that aren't quite water. The biggest one is down here, and we use the analogy of rocks to say property and equipment. So any portion of the property and equipment that you own free and clear is unrestricted, and that you could sell it. It is yours to do whatever you want with, but it isn't very easily converted to water. You have to put it on the market, you have to find a buyer, and you can't really pay your bills in the meantime with tables and chairs and HVAC. And so we want to subtract out any property you own free and clear when we want to get a sense of your true adaptive capacity or how much is in this unrestricted bucket to pay bills. The other two pieces that are in this unrestricted bucket that you may own free and clear are a board-designated reserve. So that's money that the board has set aside for a specific purpose. And they put it in the water bottle, screwed the cap on, but there is still some water in there. And if we wanted that water, we could open the water bottle and dump it back in with the board approval. So it is unrestricted, but it's removed partially for the moment. The other big piece that organizations own free and clear or could own free and clear are receivables. So that's money that people owe to you that is ice. It may become water in the future, and it likely will become water. It's a question of when. And so we want to include that when we think about all the money that you will have to pay bills over the next year. But we do want to take note that it is ice at the moment, and it's not water quite yet. So where does this show up when you look at a balance sheet? When you're looking at your balance sheet, what we're talking about here, when we want to find the unrestricted bucket, we're looking at net assets, which is everything you own free and clear, and the total unrestricted is everything in that bucket. But there are several items that you own that are, like we said, the rocks. And so P&E here is subtracting out the rocks. If you have any board designated money, that is in the water bottle. We want to pull that out as well to get what your undesignated net assets are, to really get at what is, in our analogy, water that you can pay your expenses with. So how do we calculate different ratios to understand what the true adaptive capacity of your organization is? The ratio that we use frequently at Nonprofit Finance Fund is the months of liquid net assets. And this ratio can give you a sense, an initial sense of, over the next year, how many months could you continue to keep your doors open with the resources you have right now if your expenses stayed the same. And the way that we calculate this is, if you think about the unrestricted net assets, again, that's everything in the unrestricted bucket, we're going to subtract out the rocks. And to get the rocks, it's property and equipment minus any liabilities you have on that property and equipment to get to how much is liquid or water in that bucket. And then we'll divide that by monthly expenses to give us a sense of how many months could you keep your doors open should no more resources come in. I also want to note that we look at months of cash, like I said before. It is an important ratio to keep in mind to see how much cash you have to pay bills. The caveat with total cash is that some of it is restricted, but looking at these two ratios in tandem can really give us a sense of the true financial health of the organization. So inevitably, you're all sitting there thinking, so how much is enough? When do I know that I have enough money to pay my bills? At the Nonprofit Finance Fund, we use 3 months as a loose benchmark for the point in time when you have room to breathe. So when you have less than 3 months, it really can be tough to pay bills. You're scrambling for cash. You're trying to talk to vendors about paying a little bit later. You may be relying on a line of credit. And so 3 months is a loose benchmark, and some organizations need significantly more than that. But we encourage you to think, as you look at the financial health of your organization, to critically think about what resources you need on hand should anything happen. What is the adaptive capacity that you need to make the management decisions and to enable your organization to be around in the long term? For some organizations, that could be 6 months to a year, depending on the risk of their revenue sources. So a few takeaways when you look at your balance sheet. The first thing that you want to look for is to make sure that if you have any fixed assets on the asset side, that you really are making sure that you're investing in those fixed assets. If you own a building, do you have savings in your net assets that can cover any issues that may show up in the future? Second piece, what is showing up on your liabilities? Do you have a line of credit? Do you have a mortgage? And if so, are you using that for cash flow needs or really cash needs? And do you have a plan to pay that off in the future? The third piece about cash, do you have cash to pay your bills, which is equivalent to about 3 months of expenses? And like we talked about with the unrestricted liquid net assets, do you have about 3 months of unrestricted liquid net assets as well? And the last piece that we look at as well is current assets minus current liabilities, which some of you may have heard of as working capital, which is a way to think through, do you have assets on hand to pay all of the bills that will come due in the next year? So this is a checklist that you can use when you're assessing your financial health to see whether your balance sheet is as healthy as you would like it to be as an organization. So before we move on to the new CDP tool, I saw that we do have a question. So I want to make sure that we answer that. We had someone ask if the deck will be made available to the participants, and yes, it will. We will send you a PDF after after the presentation is over so that you can reference it as needed and you can share it with your colleagues. I should also note that we will be uploading a video of this presentation to Cuyahoga Arts and Culture's YouTube website, and we'll also make sure that we send you the link to that. Before we move on and I show you the new CDP analysis tool, I want to see if there are any questions on the financial analysis piece that Nicole and I have gone through so far. If so, you can type it in the question section or in the chat section at the bottom of your screen. Okay, it looks like we don't have any questions so far, so I will go through the CDP tool, but if you have any questions as I'm going through it, please let us know. So some of you may already be familiar with the tool that has come out. What our tool does that we've partnered with CDP, the Nonprofit Finance Fund, helps CDP to develop a tool that pulls all of the information that you have inputted as an organization to really synthesize that information and put it into graphical form and an easy-to-use tool so that your organization and funders can also really make that data more accessible than it is in the current format. So the benefit for cultural organizations and for all of you is that this tool can really give you the tools that you need and information that we brought up today to help you inform strategic business planning, to help you to train new executives and board members as to what the financial health of your organization truly is, to help identify maybe some issues that you might have on the balance sheet or the income statement, to think through if you have an outside consultant rather than trying to scramble to get all of your documents together, giving them information that is in one place so that you can bring that person up to speed pretty quickly. The benefit for funders is that they're able to engage with you in a conversation about financial health and that they can use this same tool to minimize the burden on you in submitting forms to all of them. So with that, I do want to say that this tool is free. It is all that is required is that you fill out the CDP, which almost all of you do, I believe. So this is a free tool that you can access, and we will send the link to all of you when we send out the PDF. And what this tool does is the first big piece is a dashboard tool. And so what this does is it summarizes a lot of the main areas that we went over today. So it starts with overall annual performance, and that's the information that Nicole spoke about earlier today. Your estimated full cost, which is what Nicole also went over today with the pie chart. And it, at the bottom, has the balance sheet and liquidity. So you have some information about your fixed assets as well as months of working capital and cash and investments. The second piece is graphs and educational guides. So some of the graphs that we showed you today for the sample organization will be available to you as well. So there are graphs like this that show, your earned revenue detail, that detail your expenses, what your surpluses are. And this is really a way for you to make financial information accessible to those that really aren't financial experts and don't really like looking through financial data. This is a way to talk about your financial situation in a more accessible way. The last piece is financial statements. So this should look pretty familiar. It looks pretty similar to what an audit or any of your internal statements would look like, but it's a way to have a standard printout summary from the CDP information that you input. And so this will look the same for every organization that fills out the CDP. I will pause there again to see if we have any questions before we wrap up our main takeaways. Okay, we don't see any questions coming through, but we will give you our contact information at the end. Oh, someone raised their hand. Whoever it is that just raised your hand, can you try to use the chat function so that we can see your question? Okay. So whoever did raise their hand, please try to chat that to us as we wrap up our final takeaways here. The first takeaway, which is what Nicole covered, is profitability and savings. Are you covering your costs? And not only are you covering your operating expenses, but are you generating surpluses that are sufficient to cover your full cost of doing business, which might include debt principal, it might include facilities, and are you contributing to your reserves? Are you generating adequate savings for your organization? The second piece is revenue dynamics. Where does your nonprofit money come from? Are some of your revenue streams at risk? How many revenue streams do you have? And do you have enough so that you can minimize the risk of any single revenue stream? The third piece is expense dynamics. So do you understand what direct costs, what indirect costs are, and do you know how to adjust those costs should you experience revenue shortfalls? And in thinking about expenses, like we said before, not only operating expenses, but really your full cost of doing business. In thinking about the health of the balance sheet, what are those line items that are the largest for your organization? Is it receivables? Is it fixed assets? Is the nature of your assets changing over time? And if so, how do you need to respond as an organization? In terms of net assets or your net worth, how much of that is unrestricted and how much is liquid, which brings you down to the liquidity section. Is there enough cash available to cover your current obligations, and do you have enough liquid net assets available to cover your obligations and your expenses on a monthly basis? I see that someone asked a question. Can you tell people, again, how to get the financial scan report? Sure. So that is available regardless of budget size. So this tool does work regardless of budget size as long as you're submitting your CDP. Yeah, so there are two tools that we have. I should clarify that. We have a financial scan tool, which is available to all organizations, not just arts organizations. And that is based on 990 information. And you can access that through GuideStar, and we can send a link out to that as well. But that is not specifically for arts organizations. That's technically our financial scan product, but we have the CDP product is available to any organization that does file their CDP information, and it pulls from that. So any organization that does file that. And for organizations that don't, the scan tool may work for you, but you would need to be an organization with over 200,000 in revenue at least, and you would need to file the Form 990, not the 990 EZ. But the CDP tool will work for all of you. Any other questions? Okay, Nicole has a few final thoughts as we wrap up our work. I'm curious whether CHC is sharing the same information with other funders as well as with nonprofit. It seems that this context could be helpful to larger funder and grantee conversations. I will let Nicole talk to you about that one.
Thank you, Sarah, for asking that question. It actually dovetails really nicely with some of my final comments. You're right. So this is really very, very useful for a much larger audience, beyond CAC. And that's really what I wanted to wrap up by talking about, which is that we're focusing today on the nitty-gritty of reading financial statements and communicating your financial health. But really what we're talking about in the bigger picture is that as the nonprofit sector, our world is changing. And it's changing in some ways that are really for the better. And while that brings benefits to us, it also means that our responsibility is shifting. So what do I mean by this? Well, how is the world changing? First off, funders are getting more educated. The Nonprofit Finance Fund, largely in part in a partnership with Grantmakers for Effective Organizations, and an additional partnership with Grantmakers in the Arts, and our own work, has been doing funder education around the country for several years now. Funders are increasingly interested in absorbing this information and wanting to understand how they can avoid some of those unintentionally harmful best practices, trying to figure out how they can help make sure their funding is really supporting nonprofits rather than undermining nonprofits. We see so much movement in the sector right now with funders changing their policies around how they fund surpluses. Funders doing things like providing change capital and recovering capital, doing things like helping organizations pay off debt, even just a willingness to engage with organizations in a conversation that is not about what can you do for me as a funder, but what do you as an organization need to be successful. That's a really large shift. And part of that shift is this resurgence of tools that are available publicly. Things like the CDP in general. Then you've got this financial health analysis that NFF did for CDP. You've also got, GuideStar, which is continuing to get better and better and better about making publicly available financial information useful to the broader public. And now the GuideStar and NFF partnership has the financial scan tool, situation and comparables analysis, which takes that to completely the next level and making this financial information useful and available to the public. What this means is that the world around us is starting to really value the financial health and sophistication of nonprofit organizations, and we're getting better and better at being able to assess that. So even if you're not capable of understanding your financial health and making good decisions off of it, the world around you is gaining an increasing ability to make those assessments about you. And so your responsibility and your opportunity is really to be ahead of that, to say, to recognize that actually this is a shift that's good for you and not one to be afraid of, but to be very proactive in understanding your financial health, making the decisions that are going to improve it, and getting into the habit of communicating your health and your needs transparently and without apology. The other big shift that I think is starting to happen, and we'll see even more of, is an increasing desire to connect the flow of revenue and capital in the sector to outcomes, to things that are quantifiable. And as that shift happens, the organizations who have the strongest ability to understand their financial dynamics are going to be the ones most readily able to shift into a system where they need to then quantify the return on the investment that happens when someone invests in them. So this is not just about the sea change happening now, but this is really about groundwork that's going to be important to the sector for the next 50 years. And bringing it back to CAC, there's a real specific opportunity here. I mentioned that there's a shift in conversations where we don't want to talk about funding the programs. We really don't even, we don't want to talk about funding the programs. We want to talk about funding the organization. And what that means is being able to have an honest conversation about what your organization needs. So we do these workshops all the time, and nonprofits will say, oh, but first you have to find the funder that wants to have that conversation. The funders aren't there yet. Funders, yeah, I get it, but we don't always have that opportunity. Cuyahoga Arts and Culture is giving you that opportunity. And it may not necessarily be, in a sit-down conversation face-to-face, but in some ways it's even more important that it's part of the process, right? It's part of what they are requesting you to talk about. They're not saying, what can you do for us? They're saying, we want you to tell us about yourself, not to make yourself look good, but to tell us honestly how you see your organization's financial position and what its needs are, and how you are going to address that in the future. They're opening the door for you to have that conversation. A really, really positive shift, but again, your responsibility in that is to be able to take advantage of that opportunity, not just, say a story that makes you look good, but really honestly address where are the places that you need to work on, and to talk about that honestly in your application. So I want to pause there. Those are really my wrap-up thoughts. Let's take a look and see if we have any additional questions. Okay, so there's an additional question about our board believes in break-even budgets. How can I help them understand that we need to run a surplus? I'd say my answer to that has two components. The first is that when that's a situation that you're facing, it's not so much about numbers, it's about attitude and culture. What you're saying is that you have a culture of break-even, and you need to move that to a culture of surpluses. This means that your organization needs to just move its mentality to a place where surpluses are seen as a necessary and regular part of doing business. And so think about that as the umbrella. Think about that as the needle that you're trying to move. How do you create a culture of surpluses, right? Because it's not just about, oh, how do I get them to approve a budget with a surplus? It's bigger than that. It's a cultural thing. So think about it in those broad terms. And then, of course, you want to think about who's on your board, who are the personalities that are leading that camp about break-even, and think about what you need to do to move those people towards a culture of surpluses. From a numbers perspective, there's definitely one thing that I would say that can really help, aside from just providing this type of education to your board. You need to be very diligent in changing the language that you use and how you present what those surpluses are going to be used for. So you don't want to talk about surpluses as being extra. You don't want to present it as though, here's our budget, and then we're hoping we have this $15,000 surplus that we're budgeting for, and people are seeing that in some ways as a cushion or like a contingency. That's really not the point. The way to change that is to say, our full cost of business is that, for example, we only have 2 weeks of reserves on hand. Our goal is that 3 years from now, we want to have 3 months of reserves set aside, and we need to do that through operating surpluses. So to do that 3 years from now, we need to be setting aside, say $25,000. We need to be setting aside $25,000 a year into those reserves to meet that goal 3 years from now. And maybe on top of that, you're saying, okay, unfortunately, our $100,000 line of credit is maxed out, and our goal is to pay that off, in 3 years from now. So you say, well, then we need, $33,000 a year to pay that down. And your board needs to buy into those broader goals. They need to buy in first to, yes, we do need 3 months of working capital. Yes, we do need to pay off that line of credit that we've been carrying as short-term debt. And if we have a 3-year timeline, then that means, we need $50,000 of money a year to put towards those goals. And then when you budget, it's not, here's our expenses and then here's the extra surplus. It's, here's our expenses, here's the surplus deficit before, non-operating items or balance sheet items. And then you budget, here's the $25,000 to build working capital, and here's the $33,000 to pay off line of credit. And then below that, here's the surplus deficit after balance sheet items. And after all that, if the balance is zero, that's fine, because what you've done is you've budgeted to your full cost of expenses. So just help them along by showing them what that surplus is going to be spent for. And that will go a long part of the way to changing this mentality that surplus equals extra. Any other questions? All right, I don't see any other questions, and we're about 3 minutes from our finish time. Thanks so much for everyone that stayed with us for the 90 minutes and has participated by asking questions. You will be able to review this video again or share it with your board. with other key staff that you have through the Cuyahoga Arts and Culture website. And we will make this deck available to the participants today via email. Thank you so much for joining us, and thank you again to Cuyahoga Arts and Culture for prioritizing and investing in this work. You know, it's really about you as organizations and your ability to become stronger, and we're really just thankful to be you know, one of the conduits to make that happen. If you have feedback, our contact information is listed here, as well as CAC's contact information. Please do feel free to reach out. Let us know, you know, to CAC if there's additional ways that you feel your organization could use support, or certainly reach out to NFF if you have questions about today's content. Thank you so much. Have a great afternoon.